MLO services must be licensed to take a loan app or to offer or negotiate loan terms, to receive anything of value, to engage in business of an MLO with repetition, to work as an independent contractor, or to work as an attorney in the business of MLO. Monthly MIP varies based on loan amount, loan to value, and the term, but it's typically 0.55% per year. They can change based on the FHA's financial status. Sometimes can be canceled after 11 years, but typically lasts the life of a loan. Mortgage banker, a direct lender who manages the entire loan process from originating to servicing. Mortgage broker, an intermediary who assesses a borrower's financial situation and shops multiple lenders to find the best rate. Mortgage examiner takes random samples of mortgages and examines them. Can be a state official or internal compliance officer. Mortgage regulator, state or federal, and makes sure lenders comply and are financially secure. Typically a state agency. As MSBs are international, there are also international regulators. MSA, Metropolitan Statistical Area, a region that consists of a city and communities linked by social and economic factors. MSBs, or MBSs, mortgage-backed securities, which are pools of mortgages. Similar to a bond, investors receive periodic payments. MIP, Mortgage Insurance Premium, used in FHA loans, upfront MIP and annual MIP. An MLO cannot ask what? Can't ask if single, divorced, or widowed. Must say, are you married, unmarried, or separated? Or he can't ask if you are ill or disabled. Can't ask if you're pregnant either. MU4R is a form that contains identifying information such as applicant's name, date of birth, social security number, phone, residence, employment history, and disclosure questions. It is on the MLS website. The NCUA is the National Credit Union Administration, and created in 1970 to ensure deposits at federal credit unions are safe. Neo-physical asset are intangible assets. New Homeowners Act in 1998. It allows homeowners to drop the PMI at 80%. NFIP is the National Flood Insurance Program, and the government sets the rates, but it's through private insurers. NINA, no income, no job, or no assets. NMLS is the nationwide multi-state licensing system and registry. It's a web-based platform to administer licensing and ongoing compliance requirements. Non-conforming loans, not eligible for Fannie or Freddie Mac. Most common ones are verifying income from self-employment. Non-qualifying mortgage loan. Self-employment is probably the most common. Non-traditional mortgage product. Any mortgage that does not conform to standard fixed rates such as adjustable rate, ARMs, interest only, and balloon mortgages, also known as a non-conforming loan. NPI, non-public personal information, like your social security number, credit information, bank cards, phone numbers, etc. OCC, Office of Comptroller, processes corporate applications for banks and offering charters, supervises banks, and it started in 1863 under Lincoln, and it charters and regulates banks. Occupancy fraud, when borrower states they will live in the home, and they don't. OFAC, Office of Foreign Assets Control. It's part of the U.S. Department of Treasury, and it enforces actions against terrorists, drug traffickers, weapons dealing, and other threats against national security. It maintains a list of persons. This list can be checked. Par rate. The interest rate with no points, it's the starting point of interest rates. Patriot Act. It's the act that says you can search email easier, phone records easier, and eases restrictions on intelligence gathering and detaining and deporting. And it's to deter terrorists, prevent money laundering. It was enacted because of 9/11. Makes it easier to do searches. And enhances law enforcement to detain and deport immigrants suspected of terrorism. Requires institutions to verify everyone's identity. The Patriot Act disclosure for borrower identification. This form that makes banks require 2 forms of ID and makes them create an ID program. Permissible percentage. It's the amount available to access from a reverse mortgage. Phishing. It's a hacker, typically posing as someone trustworthy, sending emails asking for sensitive info or passwords, and it often includes links to websites. Permissible use. Under the GLB Graham-Leach-Bliley Act, it refers to a person or company having a valid reason for obtaining a consumer's non-public information. PITI, it's the principal, interest, taxes, and insurance. PMI, private mortgage insurance. PMI disclosure for APR. It's that the servicer must notify borrower when 1. The loan balance is at 77% or of original value. Okay, prepaid interest. Charges due at closing for any daily interest that will accrue on a loan between the date of closing and the end of the month before regular payments begin. Prepayment penalties. They're prohibited by Fannie Mae and Freddie Mac, and you cannot sell them to a GSE if they have the prepayment penalty. Private notice delivery. Privacy notices must be delivered to consumers by financial institutions initially and annually if there is an ongoing relationship. It must tell them they can opt out. PUD, Planned Unit Development. Purchase money mortgage. Closes with first mortgage from same or another lender. So it's you have another loan and it closes the same time as you close your main loan. Purchase money second mortgage. Same thing, closes with the first, also known as a piggyback second. It's for when the borrower doesn't have the 20% down, but it wants to avoid PMI. And it does not have a prepayment penalty, so some people pay it off quick. Qualified mortgage. It may not be over 30 years or have negative amortization, and it cannot be a balloon or deter principal balance. QWR, Qualified Written Request. Written to servicer who must acknowledge in 5 days and respond in 30 days, but they can extend 15 days. It must give info about who owns the loan within 10 days. Notice of the error. Rebuttal presumption. If APR is 1.5% points or more, but less than 2.25 points, it can still be a qualified mortgage, but it is rebuttable by the consumer. Red flags rule. It's under FACTA, and it's to detect identity theft. Redlining. It's denying credit in certain neighborhoods. Reverse redlining is targeting a neighborhood with high-cost loans. Regulation B is ECOA, ECOA. Regulation C is the home mortgage disclosure. Regulation E is the electronic fund transfers. Regulation F is fair debt collection. Regulation G is the Safe Mortgage Licensing Act, and it gives multiple authorities to state regulatory agencies based on the SAFE Act. Includes the SAFE Act's federal registration requirement for MLOs. Regulation X is RESPA. Regulation Z is Truth in Lending. Residual income. It's income left after taxes and housing expenses and all debts. Uses net income, and it takes the size of the family into account. RESPA, the Real Estate Procedures Act, enacted by Congress to provide buyers and sellers with costs of settlement. RESPA does not apply to commercial, business, agricultural, temporary constructions, or bridge loans. It's from 1975. And it's to ensure buyers have access to complete settlement cost disclosures, and it makes the lenders provide disclosures. Prohibits kickbacks, referral fees, and fee splitting. And the real purpose is to reduce high settlement cost. RESPA is regulated by the CFPB, the Consumer Financial Protection Bureau. Reverse mortgage requires no info book, but requires a good faith estimate. Revolving credit is like a credit card.